Most people have no idea whether their retirement portfolio is actually good or just bigger than it used to be. And that is dangerous because a portfolio can look impressive on the screen and still be weak underneath. You can log into your account, see 180,000, 260,000, maybe even 500,000 and feel proud for about 12 seconds. Then the panic creeps in. Is that enough? Is it ahead? Is it behind? Is everyone else secretly doing better? And the reason this question is so hard is because retirement is one of the few areas of money where the scoreboard is almost invisible. With income, you know if you got a raise. With a house, you know if it went up in value. With a car, you know exactly what you bought. But with retirement, the number only matters when you compare it to your age, your expenses, your savings rate, your risk level, your taxes, and your future lifestyle. So today, I want to walk you through 5 signs your retirement portfolio is above average, and more importantly, why those signs matter. Because being above average does not mean you are rich. It means your portfolio is built in a way that gives you options, breathing room, and protection against the mistakes that quietly destroy ordinary savers. Sign number 1. Your portfolio is not just large. It is large relative to your annual spending. This is where most people make the first mistake. They compare balances instead of comparing freedom. Someone with $600,000 saved and $140,000 in debt year in spending may be in a much weaker position than someone with $350,000 saved and $45,000 a year in spending. The second person has fewer dollars, but those dollars stretch further. Retirement is not a contest of who has the biggest account screenshot. It is a contest of how many years of life your portfolio can buy. That is why serious investors look at spending multiples. If you spend $60,000 a year and have $300,000 invested, you have 5 years of current spending saved. If you have $600,000, you have 10 years. If you have $1.2 million, rest you have 20 years. That number tells you much, more than the raw balance. I once talked to a man named Eric, who was embarrassed because he was 52 and had only around $420,000 saved. He kept comparing himself to people online claiming they had 7 figures. But when we looked closer, Eric had a paid off, modest home, no car debt, no credit card balance, and he was spending about $42,000 a year. His portfolio represented 10 years of spending before even counting Social Security, future contributions, or home equity flexibility. That was not a failure. That was a quiet strength. Meanwhile, his coworker had over $900,000 but was still carrying 2 car loans, a massive mortgage, private school tuition, expensive vacations, and lifestyle costs near $150,000 a year. On paper, the coworker looked richer. In reality, Eric had more control. So the first sign you are above average is that your portfolio is connected to a life you can actually afford. You know your annual spending. You know how many years your investments could cover. And you are not judging yourself by random internet numbers. You are judging yourself by the size of the life your money has to support. Sign number 2. Your savings rate is still strong, even after your portfolio starts to feel comfortable. This is one of the biggest separators between average savers and above-average investors. Average savers stop pushing as soon as the account starts looking decent. Above-average investors understand that the middle years are where compounding becomes powerful. The first $10,000 is hard because you are building the habit. The first $100,000 is hard because growth still feels slow. But once you reach $250,000, $500,000 or more, your contributions and your market returns begin working together like 2 engines on the same plane. A 10% gain on $20,000 is nice. It is $2,000. A 10% gain on $500,000 is $50,000. That can be close to someone's entire annual contribution, or even someone's salary. This is why stopping too early is so costly. A lot of people build a decent portfolio, then lifestyle inflation quietly swallows the rest. They upgrade the car, stretch into the bigger house, eat out more, subscribe to everything, and tell themselves they deserve it. And maybe they do deserve comfort. But the danger is that they stop buying future freedom right when every extra dollar has more power than it did before. An above-average portfolio usually belongs to someone who keeps saving even when they no longer feel desperate. They may not live like a monk, but they still have a gap between income and spending. That gap is the engine. Think about two families. Both reach age 45 with $300,000 invested. Family 1 says, "We are finally doing okay," and lets savings fall to 3% of income. Family 2 says, "Now the machine is finally working," and keeps investing 15% or 20%, 10 or 15. Years later, the difference is not small. It is not just a nicer retirement. It may be the difference between retiring by choice and working because there is no other option. The above average sign here is not perfection. It is momentum. Your portfolio is not just sitting there hoping the market saves you. You are still adding fuel. You still treat retirement contributions like a bill owed to your future self. And when your income rises, at least part of that raise gets captured before your lifestyle eats it. Sign number 3. Your portfolio is boring in the best possible way. This may sound strange because social media makes investing look like it should be exciting. People talk about hot stocks, artificial intelligence plays, crypto explosions, private deals, options trading, and secret opportunities. But most above-average retirement portfolios are not exciting. They are simple, diversified, low-cost, and consistent. They usually have broad stock exposure. Some bonds are cash depending on age and risk tolerance, tax-advantaged accounts when available, and a clear strategy that does not change every time the news gets scary. Boring is not a weakness. Boring is often what survives. The average investor underperforms not because they choose the wrong brilliant stock, but because they interrupt their own compounding. They chase what already went up. They panic after a drop. They hold too much cash for years, waiting for the perfect entry. They buy products they do not understand because the salesperson made them sound safe. An above-average retirement portfolio is usually boring because the owner has learned one painful truth. The goal is not to impress people at dinner. The goal is to still be solvent at 75, 85, and 95. I knew a woman named Denise who felt embarrassed because her retirement account was mostly plain index funds. Her brother was always talking about individual stocks and bragging about huge winners. But when the market got rough, he was constantly stressed, constantly moving money around, constantly asking whether this was the top or the bottom. Denise just kept buying every month. 10 years later, she did not have the most exciting stories, but she had the better portfolio. Her money had stayed invested. Her fees were low. Her taxes were manageable. Her behavior was stable. That combination is incredibly powerful. So ask yourself, could you explain your retirement portfolio in simple language? Do you know why you own what you own? Are your fees low enough that they are not quietly draining your future? Are you diversified enough that one company, one sector, or one trend cannot ruin your retirement? If the answer is yes, that is a strong sign. Above average does not always look clever. Sometimes it looks like doing the obvious thing for a very long time, without getting bored enough to sabotage it. Sign number 4. You have tax flexibility, not just account balances. This is the part many people ignore until it is too late. They think retirement planning is only about accumulation. Get the biggest number possible, then figure out the rest later. But retirement is not just about what you own. It is about what you can spend after taxes, after penalties, after required, withdrawals, after healthcare costs, and after timing problems. An above-average portfolio usually has more than one tax bucket. Maybe you have traditional retirement accounts, where money may be taxed when withdrawn. Maybe you have Roth money, where qualified withdrawals can be tax-free. Maybe you have a taxable brokerage account that gives flexibility before retirement age or helps manage capital gains. Maybe you have cash reserves for short-term needs. The exact mix depends on your situation, but the principle is simple. Tax flexibility gives you control. Imagine two people with the same $1 million portfolio. One has almost everything in pre-tax accounts. That is not bad, but every withdrawal may increase taxable income. The other has a mix of pre-tax, Roth, taxable investments, and cash. In retirement, that second person can choose where to pull from depending on tax brackets, market conditions, health expenses, and timing. That flexibility can make the same headline number much more valuable. This is why above-average investors do not just ask, "How much do I have?" They ask, "What kind of dollars do I have?" A dollar in a Roth account is not the same as a dollar in a pre-tax account. A dollar trapped behind penalties is not the same as a dollar available for opportunity. A dollar in a concentrated stock position is not the same as a dollar in a diversified fund. The label matters. The exit matters. The tax treatment matters. This does not mean you need some complicated strategy with 20 accounts and a spreadsheet. That requires an engineering degree. It means you should understand the basic role of each bucket. Pre-tax accounts may help you save on taxes today. Roth accounts may protect future spending from tax surprises. Taxable brokerage accounts may create flexibility before traditional retirement age. Cash may stop you from selling investments during a downturn. When these pieces work together, your portfolio becomes more than a pile of assets. It becomes a system. And systems are what protect people when life does not follow the perfect plan. Sign number 5. Your portfolio can survive bad timing. This may be the most important sign of all. The average portfolio assumes life will be cooperative. The above-average portfolio assumes life will occasionally punch you in the face. A market crash in the first years of retirement. A layoff in your late 50s. A medical bill. An adult. Child who needs help. A parent who needs care. Inflation that stays higher than expected. A house repair that arrives at the worst possible time. The question is not whether bad timing will happen. The question is whether your portfolio is built, so bad timing does not force a permanent mistake. This is where risk management matters. Not fear, not panic, but structure. Do you have enough cash or short-term reserves so you are not forced to sell stocks during every emergency? Is your portfolio allocation appropriate for your age and emotional tolerance? Do you have a plan for what you would do if the market dropped 30%? Do you know which expenses you could reduce temporarily? Do you have insurance where it matters? Do you avoid debt payments that would trap you if income stopped? Above-average retirement planning is not about predicting the future. It is about removing as many forced decisions as possible. Forced selling is dangerous. Forced borrowing is dangerous. Forced lifestyle cuts at the worst moment are dangerous. The strongest portfolios create space. Space to wait. Space to rebalance. Space to recover. Space to make decisions calmly instead of desperately. Think of retirement like crossing a long bridge. The average person only asks whether they have enough gas to get across if the weather is perfect. The above-average person asks what happens if there is traffic, rain, a detour, and a tire problem. That does not mean they are negative. It means they respect reality. A portfolio that survives bad timing is usually not the one with the highest return in a good year. It is the one that keeps you from quitting the plan in a bad year. And that is why emotional durability is a financial asset. If your plan is so aggressive that a normal bear market makes you abandon it, it was not really your plan. It was just a wish with numbers attached. Now, here's the important part. You do not need all 5 signs perfectly to be doing well. Most people are strong in one area and weak in another. Maybe your savings rate is excellent, but your tax buckets are messy. Maybe your portfolio is diversified, but you do not know your annual spending. Maybe you have a strong balance, but your lifestyle has crept up so much that the money does not stretch as far as it should. That is not a reason to feel ashamed. It is a map. The point of these signs is not to make you compare yourself with strangers. It is to show you where the real scoreboard is. Above average is not just a number. It is when your portfolio matches your spending. It is when your savings habit continues after comfort arrives. It is when your investments are boring enough to survive your emotions. It is when your tax buckets give you choices. And it is when bad timing does not destroy the whole plan. If you want a simple way to evaluate yourself, ask 5 questions. How many years of spending do I already have invested? What percentage of my income am I still saving? Can I explain my investments and fees in plain English? Do I have more than one tax bucket for retirement? And could I survive a bad market or job shock without making a permanent mistake? Those answers will tell you more than comparing your balance to some national average ever could. Because averages can be misleading. The average includes people with pensions and people without pensions, people in high-cost cities and low-cost towns, people supporting families and people living alone, people with paid-off homes, and people with 30 years left on a mortgage. The average does not know your life. Your plan has to know your life. And honestly, that is the empowering part. You do not need to beat everyone. You need to build a portfolio that can support the person you are becoming. You need enough discipline to keep buying freedom while you still have income. You need enough humility to avoid gambling with money you cannot replace. You need enough clarity to know what your life actually costs. And you need enough patience to let time do what time does best. The people who end up above average are rarely the ones who looked the richest at every stage. They are often the ones who quietly kept the gap between income and spending, avoided the obvious traps, stayed invested through ugly headlines, and built flexibility before they needed it. They were not perfect. They just did not keep starting over. And that may be the biggest hidden sign of all. Your retirement portfolio is above average when it has become difficult to knock you off course. Not impossible, because life can humble anyone. But difficult. You have buffers. You have habits. You have a strategy. You have options. And every year, the machine gets a little stronger. So when you look at your retirement account, do not just ask, is this a big number? Ask, is this number connected to freedom? Is it growing for the right reasons? Is it protected from my worst impulses? Can it handle taxes, emergencies, and bad timing? Is it buying me choices? Because retirement security is not built in one dramatic moment. It is built in hundreds of ordinary decisions that do not feel exciting at the time. The automatic contribution, the car you did not upgrade, the fund you did not panic sell, the raise you partly invested, the tax bucket you opened before you needed it, the emergency cash that kept you calm. These are not glamorous moves, but decades later, they are the difference between hoping things work out and knowing you have built something solid. And if you already see several of these signs in your own life, give yourself credit. You may be doing better than you think, not because the number is perfect, but because the structure is strong. And strong structure, repeated long enough, is what turns an ordinary retirement portfolio into an above-average one.